afternoon and welcome to Student Loans and 529 Plans. My name is Sherry Rikus and I'm co-founder of Rappaport Rikus Capital Management. Our firm offers full financial planning and money management. We work with families and nonprofits. We currently manage close to $600 million in client assets. Thank you for all of you who have supported us. As much as we believe investing in the markets and returns are very important, what we truly believe and what our firm really strives to do is maximize your return on life. And how do we do that? We help our clients have clarity with their financial situation. We incorporate their goals and values. We use their goals and values for full financial planning. We implement the financial plans with a process we call value-added indexing, and we'd be happy to talk in more details about this, but it's basically index funds that are very diversified and tax efficient. And we know our clients' circumstances change over time, so we continually monitor and work with clients to address all the changes in their life and make sure their plans will work for them for years and years to come. So it's my pleasure today to introduce both Patty Hughes and Terry Vergara. I've known Patty for a long time. She is a certified student loan specialist, and you are just going to be amazed of all the intricate details that come along with student loans. And we're so fortunate to have Patty today. We know you're not going to get everything today, but we hope it'll trigger enough that you'll call Patty, ask questions, and if you don't get your questions answered today, I know Patty would love to meet you. If you do have questions today, please feel free to fill them out in the Q&A, and towards the end, we will try to answer as many questions as possible. So now I'd like to introduce Patty, who will introduce herself, and we'll begin the presentation on student loans. Thank you.
Hi, my name is Patty Hughes. I'm the founder of Lake Life Wealth Advisory Group. I work closely with Sherry and David at Rappaport Rikus. They do a great job with investment management. So when I have clients that come to me needing investment management, I always feel really confident referring them to Sherry and David. About me, I'm a CPA, I'm a certified financial planner. I'm also a certified student loan professional. So my firm does comprehensive fee-only financial planning, but I also work with a number of clients that have significant student loan balances. So I went and got an additional certification so that I could actually help these people, because before I could do a financial plan, I really had to help them with their student loans, and it gets really complex, as you'll see. I'd first like to talk about types of student loans. So there's a couple different types that you should be aware of. The first type is called subsidized student loans. And these are federal direct loans. They're subsidized, and the student has to demonstrate a financial need. So the school determines the amount that you can borrow, and the amount can't exceed this financial need. The U.S. Department of Education pays the interest on these direct subsidized loans while you're in school at least half time, and for the first 6 months after you leave school, and this is referred to as the grace period. They also pay the interest during any periods of deferment or forbearance. There is one exception to this, and these are for people that took these direct subsidized loans between July 1st, 2012 and July 1st, 2014. And for those individuals, the interest will continue to accrue during the grace period. I'd like to talk about the limits on these direct subsidized loans and the interest rate. The first year limit is $3,500. It goes up $1,000 a year. So the second year goes up to $4,500. The third year and beyond is $5,500. The total undergrad loan limit is only $23,000. And the interest rates on these subsidized loans are 2.75%. So as you can see, this is just a drop in the bucket for the total cost of your college education. But they do have some great benefits because the interest is getting paid while you're in school and while you're in these grace periods. There's another type of federal loan that's called the direct unsubsidized loans. These are available to undergrad and grad students, and there's no requirement to demonstrate financial need. The school determines the amount that you can borrow based on your cost of attendance and the other financial aid that you might receive. But the difference is that you are responsible for paying the interest on these direct unsubsidized loans during all periods. If you choose not to pay the interest while you're in school and during these grace periods, the interest accrues and it becomes capitalized. So it gets added to the principal amount of your loan. These loans also have some limits that you should be aware of. They're even less than the subsidized loans. So the most that you can borrow for these unsubsidized loans is $2,000 a year for an undergrad, for a total maximum of $8,000. And for grad students, the annual limit is $20,500 with a total graduate school limit of $138,500. The interest rate on these is 4.3%. So as you can see, there's a difference between the subsidized and unsubsidized loans as far as the amounts that you're able to borrow, the interest rates. The unsubsidized loans have higher interest rates, and also the fact that the interest gets paid on these subsidized loans. And that can become a huge issue, because I've had clients come to me and they think that there's something wrong with their student loan balance when they first graduate. And this is particularly relevant for people who are, for example, doctors or attorneys who've taken loans out for undergrad and then maybe grad school and medical school. And when they see the loan balance, they say this can't be correct. It looks wrong. But what's happened is all of this interest has been capitalized and added to the balance of the loan. So their new loan balance is actually much higher than what they thought. So there's one other type of loan that I wanted to talk about that I think everybody should be aware of, and this is called a Parent Plus loan. This loan, as you can see, it's by the name of it, it's made to the parent of a dependent student, and it cannot later be transferred to the child. The school determines the amount of the loan, and it's based on the cost of attendance at the school. The current interest rates are 5.3%. So as you can see, the interest rates on these are higher than the unsubsidized or the subsidized loan. There's also an additional loan fee of 4.236% of the amount of the loan. And these loans can only be repaid under an income-driven repayment plan only if they're consolidated into a direct federal loan. And even if they're consolidated, the only plan that's available is known as the ICR plan. And this is one of the most unfavorable plans that's out there as far as income-driven repayment plans. The important thing is when you look at these Parent Plus loans, you can see that there's going to be a gap. I mean, if the student doesn't have financial need, the only loans that are available to them are going to be these unsubsidized loans, and the limit is so low. As an undergrad, it's only $8,000. So then that doesn't cover most of the cost of the tuition and room and board and everything. So many parents are tempted to take out these loans, but the thing that becomes a problem is that oftentimes parents who take these out, then they're entering into retirement. And then these loans can actually jeopardize their own retirement. So it's very important for them to realize that if they take a loan on behalf of their child, it cannot later be transferred to that child. So they are responsible. And if they have large loan payments to make in their retirement, sometimes this becomes a real big problem. I've had a lot of clients come to me who are in their 50s who have significant Parent Plus loans, and they thought that the kids would be able to pay them back, and they can't. So it's really important to understand that. So moving along, the next thing that we're going to talk about is a polling question. So if you have Parent Plus loans, what choices do you have for income-driven repayment plans? IBR, pay as you earn, repay, ICR, or the last answer, they are only available for income-driven repayment plans unless they're consolidated into a direct federal loan. So I'll give you a few minutes to answer the polling question, and then we'll go over the answer. So if I look at the answers, it was IBR, 25% of the people chose that. 25% of the people chose ICR, and the remaining 50% said they're not available for income-driven repayment plans unless they're consolidated into a direct federal loan, and that is the correct answer. So it is really important for parents who are considering these Parent Plus loans to realize that their options are limited, and also that they have to worry about jeopardizing their own retirement. So what is an income-driven repayment plan? Most people don't really understand what it is, but if you think about it, an income-driven repayment plan, it's a repayment plan that would set the monthly student loan payment at an amount that's intended to be affordable based on their income or family size. So what that tends to mean is for people who are looking at an income-driven repayment plan to get a lower payment, they're looking at trying to get a lower payment than they would get under a standard repayment plan. So it usually results in a lower payment, otherwise you wouldn't choose one of these plans. The remaining balance gets forgiven at the end of the term of the loan, and the terms vary. The balance forgiven, however, is taxable income. So it's something that people need to be aware of, that there is what they call a tax bomb at the time the income gets forgiven. And there's a couple different types of these income-driven repayment plans that we're going to discuss in the next slide. This chart looks very confusing, I'm sure, but this is something when I work with clients on student loans, I show them this chart because depending on the type of student loan that you have to look at the type of student loan and then look at what your options are. So for direct subsidized and the unsubsidized loans, these are eligible for any of the income-driven repayment plans. But for some of these other loans that people might have, like these FEL loans or the Parent Plus loans, these are limited, so the eligibility is limited. So we're not going to go over this whole chart in detail, but just know that depending on the type of loan you have, you may not be eligible for all these different income-driven repayment plans. So these income-driven repayment plans, there's a couple different types. The first one is known as IBR. The second one is pay-as-you-earn. The next one is the repay program, and then the other final one is called ICR that we briefly just touched on. The important thing to know about these income-driven repayment plans is how they're calculated. So the calculation is based on your discretionary income. So discretionary income for this purpose is your adjusted gross income minus 150% of the annual poverty guideline amount for your family size at your resident state. So that's important to note because if it's based on the starting number is adjusted gross income, this can be lowered by contributing, for example, to a 401k or for pre-tax medical deductions for things like that. So for my clients that are in income-driven repayment plans, I always like to see if we can minimize their adjusted gross income to get the payment a little bit lower. The other thing that you need to be aware of when you're looking at these different income-driven repayment plans is whether or not you have a partial financial hardship. Some of these plans require a partial financial hardship. So the definition of this is that the income-driven repayment amount that's calculated based on this discretionary income, this would have to be lower than the amount that's calculated under a 10-year standard repayment amount. So in other words, when you're looking at any of these programs, you would have to calculate what your payment might be, and you would compare that to what you would pay under a standard repayment amount. And if it's lower, then you are considered to have a partial financial hardship, and you would be eligible for those plans that require it. So for the IBR, which is the first one, it's one plan, but there's different dates. There's a new IBR program and an old IBR program, depending on when you're a new borrower. So if your loans are after July 1st of 2014, you're considered a new borrower and the terms are only 20 years. If the loans are after July 1st or before July 1st of 2014, you're an old borrower and the terms are 25 years. So the terms are less favorable, and also the way it's calculated is less favorable for the older loans. It's calculated based on 15% of discretionary income as opposed to 10% for the newer borrowers. The pay-as-you-earn program is calculated based on 10% of your discretionary income. And again, there's some different dates that you have to qualify for. So the things that are really important to look at when you're looking at these different plans are, first of all, do you need a partial financial hardship? So when I look at these loans, that's the first thing I look at. Would they qualify for a partial financial hardship? Because if they don't, then it's limited to the repay program or ICR. If they have a partial financial hardship, we can look at the IBR program or pay as you earn. The other thing to consider is, are these borrowers married? If they're married, you want to see, can you file separately to lower your payments so that they're only looking at your income and not your and your spouse's income. So the IBR and the pay as you earn program allow you to do that. The repay program does not. So it looks at both incomes regardless of how you file your taxes. So if you're two high earning people, sometimes the repay program payments just get way out of line, as the incomes go up. The other thing is, do these programs have a payment cap? The IBR and pay as you earn do have payment caps. So the payment will never exceed what you'd pay under a standard repayment plan. The repay program has no payment cap. So if your income is expected to continue to go up, there's no payment cap and your payment is just going to get greater and greater. So I would just like to give you a quick example of how this all comes into play before we go to our polling question. I just worked this week with a doctor who has significant student loans. They're like $470,000. So the thing is, right now she's making really good money. She's a specialist. So she had to do, she took out undergrad loans for 4 years. She did a master's program for 2 years. Then she did medical school, and then she did a fellowship after that. So she really, had a lot of education before she started working a full-time job. So how that all comes into play is then, she all of a sudden has, her income has gone up substantially since when she was in her residency. So if she chose one of these IBR plans or pay as you earn, she would have a payment cap. So her payment would not continue to increase. If she chose, for example, the repay program, her payment is going to just keep going up as her income went up. So that's something to consider. Also, another thing that's really important for people like that who have really significant student loans, where sometimes the student loan payments don't even cover the cost of the interest. There's different interest benefits. These subsidized loans under the IBR program or pay as you earn, 100% of the unpaid interest gets paid for the first 3 years. For the repay program, it pays 100% of the unpaid interest for the first 3 years and 50% for all remaining years. And for the unsubsidized loan, it pays 50% for all years. So for a person like this really comes into play because her payments originally were not covering even the interest. So it's really important to look at the interest benefit and to say, is this really valuable, and to run the numbers and see what makes the most sense. So it does become very complex very quickly, looking at your type of loans and the type of income, and is your income going to go up? So it's a lot of things to look at. So now we have another polling question. So this question, we haven't talked about it yet, but I kind of just wanted to test your knowledge. So I don't expect that you'll know the answer, but the balance of the loan that's forgiven under PSLF or Public Service Loan Forgiveness is taxable. True or false? So I'll give you a few minutes to answer the question. Okay, so the results of their poll are 25% true and 75% false. So the answer is false. The balance under loans with Public Service Loan Forgiveness is not taxable. So that's a huge benefit. For example, if we refer back to the client that I'm talking about, the doctor, she's working for a nonprofit hospital. So she's going for Public Service Loan Forgiveness. So she's eligible to have her loans forgiven after 10 years and the balance won't be taxable, which is a huge benefit for the amount of loan that would become, that would be forgiven for her. So I get so many questions on Public Service Loan Forgiveness. So the main thing is, people always think it's the job that they do, but it's not. It's who's your employer. So you need to work for a public service organization. You need to work on a full-time basis, which their definition is 30 hours a week. The type of loans, they need to be direct loans or other federal loans that are consolidated to direct loans. And then as far as payment plans, they need to be on an income-driven repayment plan. And for payments, they need to make 120 on-time, full scheduled monthly payments. These don't have to be consecutive. So you could have a job that you did when you first graduated college, and maybe you worked there for a couple years, and now you went back to working for a public service organization. So all of these payments could count. So, so it's just important that you need to make sure that if you're going for public service loan forgiveness, you have to make sure it's the right employer, that you're full-time, that you have the right type of loans, and you're on the right type of payment plan, and that you achieve these 120 payments. So what are your options for federal loans? Not all federal loans are eligible for income-driven repayment plans unless you consolidate them. There's variation in income-driven repayment plan based on the date of your loan, so it's really important to look at the date you are a new borrower, and also to know that not all loans are eligible for public service loan forgiveness. So I'd like to wrap up this presentation on student loans because I know it's really complex, and just kind of give you some takeaways. It's important to understand the type of loans that you have so you can make the best decision on how to repay your loans. Forgiveness under income-driven repayment plans is taxable, and forgiveness under public service loan forgiveness is not taxable. If your income will increase over time, be aware that only IBR and pay-as-you-earn programs have payment caps that limit your payments to the amount under a standard repayment plan. If you're married, the repay plan is going to consider both incomes in the payment calculation, while IBR and pay-as-you-earn plans allow you to file separately to potentially obtain a lower payment. The other thing that I didn't mention, but it's so important, is that you have to certify your income at least annually, and you can recertify earlier if you experience a drop in income, which would lower your payment on an income-driven repayment plan. So I know that's been a lot of information to digest, but if you have any questions, please feel free to contact me after the presentation. And thank you for listening to all of this. It's been a lot, but I hope you learned something today about student loans.
Wow, thank you, Patty. And that is a lot of information. Patty does have a test that we're going to send later on. It won't be part of your final grade, so don't worry about it. Just kidding. But we are so fortunate that we do have an expert in Patty, because you can see the complexity, and making wrong decisions can have a detrimental effect on your financial situation. So thank you, Patty. So now it's my pleasure to introduce Terry Vergara. She is our 529 resident expert at our RCM, Rappaport Rikers Capital Management. We call her all the time. I'm going to let Terry introduce herself as well as start talking about student loans. So take it away, Terry. Thank you.
Great. My name is Terry Vergara. I'm a certified financial planner and a wealth planner at Rappaport Rikers Capital Management. I'm excited to be here today, and let's get started talking about how college savings plans can benefit you and your family. So we're going to start with a quick poll. What is the average annual cost of private college, including tuition, fees, and room and board? Is it A, $25,000, B, $40,000, C, $50,000, or D, $70,000? Oh, and you guys maybe have been studying up on 529 plans, and that you all got the answer right. The answer is C, $50,000. This is the average for private colleges in 2019 and 2020. If your student chooses an in-state public school, the cost can be a lot less. So let's take a look to learn about how 529 plans you can save for the college expenses. 529 plans are named after Section 529 of the IRS tax code, which gives the account special tax advantages. The accounts are designed to encourage parents and others to save for college. The accounts can now also be used for primary and secondary education. The account opening process is easy to complete online, and the accounts can be linked to a checking account to make annual or automatic contributions. So who can open an account? Parents, grandparents, family members, friends, even trusts can be the account owner. Who can be the account beneficiary? Any U.S. citizen or resident alien with a tax ID number can be the beneficiary. However, each student should have their own account. The account owner has the ability to change the beneficiary, and we'll talk more about that in a minute. Who can contribute to an account? Anyone. You do not have to be the account owner to contribute to an account. There are no income limits or contribution limits aside from the annual gift limit of $15,000. So let's take another quick poll question. This one's a true or false. Illinois Bright Start 529 plan account funds can only be used for in-state college tuition expenses. True or false? Okay, and the answer is false. The funds can be used at a wide range of schools, public and private colleges and universities, vocational schools, trade schools, technical and professional institutions, as well as some foreign schools. The funds in a 529 plan account can be used for qualified expenses at any of the schools I just listed. Qualified expenses go beyond just tuition and room and board. You can also use the funds to cover books, fees, and computer equipment. So now that we know how a 529 plan account works, let's talk about the tax advantages. In a 529 plan account, contributions, income, dividends, and capital gains all grow free from federal and state income taxes. That's a big advantage compared to a savings account or brokerage account, where you pay taxes on earnings each year. In 529 plan accounts, all withdrawals for qualified expenses, which we just discussed, are free from federal and state income taxes. This means that when you request a distribution for a tuition payment, you don't include those funds on your income tax return. Right, so each year, Illinois taxpayers can deduct their contributions to 529 plan accounts. Individual taxpayers receive a deduction up to $10,000, and married couples filing jointly will receive a deduction up to $20,000. Other states offer tax benefits for residents that contribute to their in-state plans. Gifting can be an important part of estate tax planning. Every contribution to a 529 plan account is considered a gift to the beneficiary. A gift in the eyes of the IRS are no longer included in the giver's estate, even if they are the account owner of the 529 plan account. The account is included in the beneficiary's estate, not the estate of the account owner. In 2020, the annual federal gift limit is $15,000 per individual, which means one person can give $15,000 to another person without needing to complete a gift tax return. It also means a married couple, so parents or grandparents, can gift $30,000 annually to an individual. 529 plan accounts have an additional gifting rule that allows individuals to contribute up to $75,000 or 5 years worth of gifts to each beneficiary in a single year without federal gift tax consequences, providing that there are no other gifts to the beneficiary in the same year or in any of the succeeding 4 calendar years. This election needs to be made on a federal gift tax return, and you should consult with your tax advisor. However, it's a great way to quickly fund the account and move a large amount out of your estate. So this is our last poll question. And what happens to a 529 plan account if your student receives a full scholarship for college? A, you lose all the money invested in the account. B, the account balance goes to the student at age 21. C, if you withdraw the funds, you're only taxed on the earnings portion. D, you can use the account to complete your own master's degree. Or E, both C and D. Okay, and so the correct answer is E, both C and D. As the account owner, you have the flexibility over the withdrawals and the beneficiary. So even though the 529 plan accounts are considered gifts to the beneficiary, the account owner is able to maintain control over the account. Traditional custodial accounts are turned over to the minor at age 21 in Illinois. This means the student gains full control of the account and can choose how they want to spend it, on college or on something else. With 529 plan accounts, the account owner always maintains control over the account withdrawals. If a withdrawal is made and it is not for a qualified expense, taxes and a 10% penalty are owed on the earnings portion, but not on the contribution portion of the withdrawal. There is an exception for scholarships and grants. You can withdraw the amount of the scholarship from the account penalty-free and only owe taxes on the earnings. Another unique feature of the 529 plan accounts is that the account owner can change the beneficiary. The new beneficiary can be another child or family member or even themselves. This feature is incredibly useful if the student receives a scholarship or if funds are left over in the account after the student graduates. 529 plan accounts also offer benefits to the family during the financial aid process. 20% of student-owned assets, such as a custodial account, are included in the calculations for the expected family contribution. However, only up to 5.64% of parent-owned 529 plan accounts are included in the calculations, which is a great advantage for the family. All right, the investment choices for 529 plan accounts are similar to choices you have in your company 401k retirement plan. You can invest in stocks, bonds, or some mix of both. You can create a portfolio of mutual funds, which is a mix of stock funds and bond funds. However, it is up to the account holder to manage the funds and make adjustments. You can also select a target-based fund based on the age of the beneficiary. Age-based target funds are an excellent way for the account owner to invest because they automatically adjust the asset allocation over time. The asset allocation is the mix of stocks, bonds, and cash. In the example, you can see at age 0 to 2, 90% of the mutual fund is invested in stocks. This aggressive allocation is appropriate because there is a long time horizon before the student goes off to college. As the beneficiary ages, the allocation changes and the percentage held in stocks decreases. At age 11 to 12, the fund has switched to 50% stocks and 50% bonds. At age 19, the funds are now only 10% stocks. Investing the funds in your account for the long term allows the market to work for you. This chart shows the power of investing over the long time horizon. It assumes the 529 plan account is open with $2,500 and that there is an average annual return of 5%. On the left, you can see different monthly contributions, and across the top are various investment periods. The greatest benefit comes from consistently adding to the account over a long period of time. So the best investment advice is to get started while your student is young. 529 plan accounts make saving for college easy. The accounts grow free from federal and state taxes, and withdrawals for qualified expenses are tax-free as well. The account owner maintains control over account funds and have the flexibility to change the beneficiary. If possible, it's best to start saving for college early so you have a long time horizon to invest the funds and watch them grow. Setting up automatic monthly contributions and investing in an age-based target fund make managing the account easy. Don't get discouraged or overwhelmed by the cost of college. It's not too late to get started since every little bit you have put aside will help your student when the time comes. Thank you for joining us today. I'm going to turn it back over to Sherry to see if we have any questions.
Thank you, Terry. Now you can see why Terry is our resident expert on 529 plans at our office. Very, very knowledgeable. We have both Terry and Patty's contact information here. So if you want to jot down emails or phone numbers, I know they're happy to answer questions if we don't get to all your questions today, but we do have a few, so I'm going to start with them. Patty, the first one's for you. How does one even begin the process of figuring out which student loans make the most sense for them?
Well, it's kind of, the first thing to do is to look at the type of loans that you have. So if you have direct unsubsidized or subsidized loans, or are these FEL loans, which are older loans? So the first step would be to identify the type of loans that you have. The next step would be to look at the dates these loans were dispersed. So when you were actually a new borrower, because a lot of these different repayment programs require different loan dates. So that's also very important. And then after that, it's looking to see if you have a partial financial hardship. So it's a series of steps, the type of the loan, and then, you know, like you've got to look at what the payments are calculated at, the dates of the loan. Then after all that is done, then you run the numbers and you see what the payments look like. You see how much is going to be paid out over the life of the loan, when it's going to be paid off, and then if it's taxable, you get an estimate of how much tax you would owe at the end of the loan. And then also it's important to look at the type of employer, like where do you work? So if you're eligible for PSLF, then you want to look at you know, getting in an income-driven repayment plan so that you can take advantage of that, having the loan forgiven in 10 years.
But what about when the student is applying to college or going to college? How do they decide which loans they should be taking?
Well, when I talked about the different types of federal loans, the subsidized loans have the lowest interest rate and the interest gets paid while you're in school. So of course you'd want to maximize those. But the thing with those is that they're limited, because the first year you're limited to $3,500 and then it only goes up $1,000 a year. So there is a limit on those subsidized loans. The other thing is you have to demonstrate financial need, but those are the best loans to start with. Then you go to the unsubsidized loans where the loan limit is $8,000, and for the whole college education, the interest is a little bit higher. So that would be the second most favorable thing. And then after that, it's really a matter of looking at private loans. So does your college offer certain loans, or do you need to go to a bank and trying to get the lowest interest rate? So it's because you can see with those loan limits, you know, for the unsubsidized and the subsidized loans, it's not going to cover much of your tuition. And that's actually why this 529 plan presentation is so relevant, because there is such a gap when you see what these loan limits are.
And then the next question is it beneficial to consolidate your student loans?
It can be. In some situations, you need to consolidate the loans to be eligible for an income-driven repayment plan. But if you're already on an existing income-driven repayment plan and you consolidate the loans, when you consolidate the loans, the time clock starts over for forgiveness. So a lot of people aren't aware of that. By consolidating the loans, you're restarting that clock on whatever time frame it is that you're looking to get forgiveness. If it's for PSLF, you're going to be looking at a 10-year time. And if with some of these other programs, it's 20 or 25 years. But I've had clients come to me and have said, oh, I'm going to be done with my loans in 2 years, so I really need financial planning advice. And so then when I look at the loans and they just consolidated maybe a couple years ago, then I said, no, that's not the case. You have like maybe 8 more years, or in some cases 15 more years to go, because that consolidation restarts the time clock. Consolidation can be valuable. Some people I mean, I've just seen some where they have like 15 loans because they've borrowed for undergrad, graduate, and say medical school, and they just want to make one payment. And when they first get out of school, sometimes they say, I just want to consolidate. So sometimes that makes sense. So they consolidate the loans to make one payment. But the one thing to also keep in mind with that is your interest rate on that is going to be higher than the individual loans. They look at the weighted average interest rate on all the individual loans, and then they increase it by 0.125%. So you are paying a slightly higher interest rate. So you're paying a little bit more for the convenience of making one payment. So there's a lot of things to consider if you're going to do a consolidation.
So I guess the answer to that question is call Patty, because there's a lot of different information. So Terry, this question's for you. If you go to Bright Start, there's the Vanguard option and then there's other options. What would you recommend for people? Should they go with the Vanguard or not?
Yeah, we recommend the Vanguard options, usually the moderate index level. It's more affordable, there's lower fees, and we think it's a great option for kids.
And can you set up you mentioned to make those payments, you know, the 500, can you set it up from your checking account so it automatically goes out every month?
Definitely. Yeah, that's kind of the best way to do it. Set it and forget it. Because then
Oh,
it
I like
automatic.
that. Set it
Yeah,
and forget it. I think we'll
right?
trademark that.
Yeah, I think that's the best way to do it. It's kind of, then it just becomes automatic. If you have to kind of think about it each year, I mean, that's, you know, you could always change the payments, you know, if you get a bonus or at the end of the year, you can always add more funds in. But if you can set a little bit monthly aside, then it's just like an automatic, it goes out of your checking. You don't even have to worry about it. You can pick the date. It can be right after payday. You can just have it go right out.
Don't be distracted by this. I pushed it ahead, but we are having another webinar on October 20th if you're invested in your sleep. I know it's been hard to get sleep nowadays, so we hope you will join us on that, but I didn't mean to jump ahead. Hopefully you got all their contact information. Patty, probably one of the last questions we're going to have tonight, in lieu of the pandemic and CARES Act, is there any suspension of loans or anything that people should be aware of regarding student loans?
Yes, right now the payments and the accrued interest is suspended until December 31st. So it's really important to know that you don't have to make student loan payments during this time. And for a lot of my clients, if they're running short on cash, or or they want to use this extra money to invest, to invest in their retirement accounts or whatever it is, I tell them it's a great time to do that. The other thing is that you also don't have to recertify your loan during this time period. So you don't have to submit an update in your income. So if your income has increased, normally you have a certain date, an annual recertification. But with this CARES Act, you don't have to recertify during this time period. So that's good. If your income's gone up, then it's a good thing. You don't have to recertify until January 1st. And then they'll let you know what, the date that you need to do your recertification.
Great. Well, thank you both. And again, feel free to reach out to Terry or Patty with any individual questions. And now I have the right slide. We try to do webinars a couple times a month. This should be a really fun one. We've already received a lot of response on it, but it's, are you invested in your sleep? We'll maximize your return on life, but we want to help you get invested in your sleep. And we have a sleep wellness expert, Nancy Rothstein, will be here and offer practical solutions. So we hope that you will join us. We also have a Rappaport Rikers Capital Management YouTube account that has all of our webinars. We'll be posting this one as well. And just so you guys have a little peace of mind, I was just kidding about the exam. There is no exam. Just call Patty or Terry. Thank you both. Thank you, Patty, for being our guest today. And we hope everyone stays healthy, and best to everyone who's with us today. Thank you.
Thank you.